Most people think money is personal. You work, you earn, you spend, you save. Simple. But your financial life is being shaped by people you will never meet. Inside institutions, most people barely understand through decisions that are deliberately technical so they feel distant and neutral. The interest rate on your mortgage, the return in your savings account, the price of stocks and houses, how easy it is for your employer to borrow and hire, even how fast your grocery bill rises. None of that is random. It is policy. And the policy engine at the center is the central bank. This is not a conspiracy story. It is a systems story because central banks do not control you by force. They control the environment you make decisions in. They change the cost of money, the flow of credit, and the risk appetite of the entire economy. And once that environment shifts, your behavior shifts with it. In this video, we are going to break down exactly how that works. Not in abstract theory. In mechanisms, you will see the levers, you will see the transmission chain, you will see who benefits first, who pays later, and why understanding this is one of the highest leverage things you can do for your financial future. Central banks are often described with polite language. Price stability, full employment, financial stability, those phrases sound clean, technical, almost boring, but translated into plain English, central banks are trying to answer one impossible question. How do we keep the economy warm enough to grow without overheating into inflation or freezing into recession? Too much heat, prices run away, and money loses credibility. Too little heat, businesses cut investment, jobs disappear, and debt becomes heavier in real terms. So central banks stand in the middle, constantly adjusting the thermostat. The problem is the thermostat controls millions of people at once. If a central bank raises rates to cool inflation, your payment on variable debt may rise next month. If it cuts rates to stimulate growth, asset prices may jump before wages do. If it expands liquidity in a crisis, markets recover fast. But the long tail effects can widen inequality. That is why people feel confused. They hear one message, policy is for macro stability, but experience another, my cost of living is changing faster than my paycheck. Both are true. And if you only remember one line from this section, make it this. Central banks rarely touch your money directly. They control the channels your money must pass through. Money has a price. That price is interest. When a central bank changes policy rates, it is not just adjusting a number on a screen, it is changing the baseline price of borrowing across the entire system. Think of it like gravity in finance. When rates are low, borrowing feels lighter. People and companies take bigger positions, bigger homes, larger business expansion, more leveraged investments. When rates rise, gravity gets heavier. Projects that look profitable at 2% suddenly fail at 6%. That single shift forces millions of recalculations. A family postpones buying a house, a startup delays hiring, a corporation refinances less and cuts discretionary spending, a government faces higher debt service and tougher budget choices. Now, the key point, central banks do not directly set every interest rate you see, but they influence the entire rate structure, short-term funding costs, bond yields, risk premiums, and eventually consumer loan pricing. So, when policy tightens, banks raise lending standards, credit cards get expensive, auto loans get stricter, mortgage affordability collapses faster than most people expect. And because modern economies are debt-driven, this is not a side effect. It is the mechanism. This is why rate hikes feel delayed at first, then suddenly everywhere, policy moves quickly, transmission takes time, then the impact arrives in clusters. Which leads to the next question. If central banks influence rates, who actually creates most of the money in your day-to-day economy? Most people imagine money as something printed by the government and distributed into the economy. That is only part of the story. In modern banking systems, most money is created when banks make loans. A bank approves a loan to a business. At that moment, a deposit appears in the borrower's account. New purchasing power enters circulation. No truck delivered piles of cash. Balance sheets changed, and the economy gains spendable money. This is why credit cycles matter so much. When banks are eager to lend, money expands through credit creation. When banks become cautious, money creation slows or contracts. Central banks influence this cycle through several channels: policy rates, cost of funds, reserve conditions and liquidity, regulatory signaling and risk expectations, lender of last resort backstops in stress periods. The result is powerful. Central banks can make credit expansion easier or harder without ever calling you personally. If rates are low, liquidity is abundant, and risk sentiment is strong, lending grows. Asset prices often rise because more money chases financial and real assets. If rates rise and uncertainty spikes, lending slows and the economy can decelerate hard. This explains a common paradox. People ask, why is the economy slowing if there is still money in the system? Because what matters is not only the stock of money, it is the flow of new credit and how fast it is moving. A stagnant flow can feel like a shortage even when total money is high. Central banks understand this deeply. That is why their communication is almost as important as their actions. Markets and banks respond not just to today's rate, but to expected policy path. In other words, central banks influence behavior through present prices and future expectations. They move money by moving belief. Inflation is not just prices going up, it is a credibility test. If households and businesses believe inflation will remain high, they adjust behavior. Workers demand higher wages sooner. Firms preemptively raise prices. Contracts incorporate higher expected inflation. Savers lose trust in fixed returns. Inflation then becomes self-reinforcing. So, central banks target inflation partly to manage current prices and partly to anchor expectations. If they lose credibility, restoring trust can require painful tightening later. This is why central banks sometimes keep rates high even when people are already hurting. To the public, that can look cold. From a policy lens, it is a calculation. Tolerate short-term pain to prevent long-term monetary disorder. History gives us repeated versions of this tension. When inflation is underestimated, policymakers risk falling behind. When tightening is too aggressive, they can trigger recessions deeper than intended. There is no perfect route, only trade-offs with consequences. And this is the part many personal finance conversations skip. Your financial strategy should be built around policy regimes, not headlines. In low and stable inflation regimes, long-duration risk assets often thrive. In high and volatile inflation regimes, cash flow quality, pricing power, and debt structure matter far more. Central banks cannot remove uncertainty. They define the boundaries of uncertainty. In normal times, central banks rely heavily on short-term policy rates. In crisis times, normal tools can become too weak. When panic hits, financial plumbing breaks first. Funding markets freeze, liquidity disappears, banks hoard cash. Forced selling drives prices below fundamentals. At that point, a central bank can switch into emergency mode. This is where tools like quantitative easing, emergency lending facilities, and large-scale liquidity operations appear. QE is often simplified as money printing. A more precise description, the central bank buys financial assets, typically government bonds and sometimes other high-quality assets, to inject liquidity and compress yields. That does several things at once. Stabilizes bond markets, lowers long-term borrowing costs, pushes investors out the risk curve, supports asset valuations, signals policy commitment to preventing system collapse. In 2008, these actions were framed as preventing financial implosion. In 2020, they were deployed with extraordinary speed to stop a liquidity shock from turning into a full depression dynamic. But every emergency intervention has second-order effects. If liquidity is abundant for long periods, asset prices can disconnect from wage growth. Those who already own assets often recover first and fastest. Those with little or no assets experience the recovery mainly through delayed labor market improvements and higher living costs later. This is how policy aimed at system stabilization can also intensify distribution gaps, not by intention, by transmission order. Money reaches Wall Street channels before Main Street wages. When policy eases aggressively, the first visible reaction is often in markets: stocks, bonds, real estate, venture funding. Financial asset holders benefit quickly through price appreciation. Borrowers with strong credit can refinance and reduce costs. Large firms can issue cheap debt and buy back shares or fund expansion. Meanwhile, wage adjustments are slower. Rent and essentials may rise faster than salaries. Savings in low-yield accounts can lose purchasing power in real terms. So two people can live in the same economy and experience opposite realities. One sees opportunity and growing net worth. The other sees higher costs and shrinking margin. Both are reacting to the same policy regime. Then the cycle reverses. When central banks tighten to fight inflation, variable debt holders get hit. Housing affordability drops, weaker firms face refinancing stress. Labor markets cool with a lag, speculative assets reprice downward. Now, highly leveraged participants suffer, while disciplined savers may finally get real yield again. The point is not that one side always wins. The point is that policy cycles redistribute pressure and reward through different channels over time. If you do not understand the cycle, outcomes feel unfair and random. If you do understand it, you can at least position intelligently. Even if you never trade currencies, global monetary dynamics affect you. Major central banks influence global capital flows. When rates rise in reserve currency economies, capital can exit weaker markets. Currencies can weaken and imported inflation can rise elsewhere. Commodity prices, shipping costs, and external financing conditions all feed back into domestic inflation and growth. So a central bank may be responding not only to local data, but to global stress signals. Foreign demand weakness, energy shocks, geopolitical disruption, cross-border funding pressures. This means your local cost of money is partly connected to a global policy network. It also explains why central bankers talk constantly about data dependence and uncertainty. They are steering a domestic mandate through global turbulence with delayed instruments. A rate decision today might fully manifest in 12 to 24 months. By then, the world may already look different. That lag is one of the hardest parts of monetary policy. They are always driving forward while looking through a fogged windshield. One of the most underestimated tools central banks have is language. Statements, press conferences, projections, and tone can move markets before any actual policy change. Why? Because finance prices the future. If participants believe rates will remain high longer, yields adjust now. If they believe cuts are coming soon, risk assets can rally before the first cut happens. This is called forward guidance, but practically it is expectation management. Central banks use it to shape behavior with minimal immediate force, cool speculative excess by sounding hawkish, prevent panic by signaling readiness to support liquidity, encourage borrowing and spending by promising accommodation. It is powerful because it is cheap. Words can move trillions without a single transaction. It is dangerous because credibility can break. If central bank guidance repeatedly misaligns with outcomes, markets stop trusting signals. Then policy has to rely more on hard actions, often at higher cost. So when you hear central bank language, treat it like strategic messaging, not neutral narration. They are not only describing the economy, they are trying to shape it. Understanding central bank mechanics is useful only if it improves real decisions. Here's the practical framework. First, identify the regime. Easing cycle, tightening cycle, pause with uncertainty, crisis intervention. Second, map your exposure. Fixed versus variable debt, cash reserve quality, asset concentration, income stability, refinancing needs. Third, adjust behavior before pressure peaks. In easing regimes, avoid confusing liquidity-driven asset inflation with permanent value, lock in favorable long-term financing when fundamentals justify it, maintain risk discipline even when money feels easy. In tightening regimes, prioritize balance sheet resilience, reduce fragile leverage, extend runway on cash flow needs, be selective with risk assets, and focus on quality and high inflation uncertainty. Protect purchasing power, favor pricing power, and real cash flow over pure narrative growth. Watch real rates, not just nominal headlines. The goal is not to predict every rate decision. The goal is to become anti-fragile to policy shifts. So do central banks control your money? Yes, but not in the cartoon sense. They do not decide your exact salary or your grocery list. They cannot force productivity growth out of weak economies. They cannot repeal geopolitics, demographics, or supply shocks. But they do control the monetary climate in which all financial choices are made. They set the baseline cost of time in money terms. They influence credit creation. They shape risk appetite. They anchor or unanchor inflation expectations. They intervene when financial pipes crack. That is a profound form of control. And once you see it, many mysteries disappear. Why markets rally during bad news? Why housing can surge while wages stagnate? Why cash feels useless in one era and powerful in another? Why the economy feels different depending on where you sit in the income and asset distribution? The system is not random. It is structured. Money is not only something you earn, it is something you navigate. And the people who navigate best are not the people with perfect predictions. They are the people who understand the rules of transmission, how policy becomes prices, how prices become behavior, and how behavior becomes outcomes. Central banks will keep changing the environment. That will not stop. What can change is your awareness. Because once you understand how central banks actually control your money, you stop treating financial shocks as personal bad luck and start treating them as signals in a system you can read. If you want to keep building that lens to understand how power, policy, and wealth really connect, subscribe. The next videos will keep decoding the system most people live inside but never see.